Here we go. We are officially live, broadcasting only on onedealaway.com/live. My name is Neb. This is Money Matters, and we broadcast live every morning at 7 a.m. Eastern Daylight Time or Eastern Savings Time. I guess it depends on time of the season as I am learning how these things go. Anyways, today is Saturday, September 5th, so it's Labor Day weekend. Happy Labor Day weekend for everybody who has labor, which sounds like there are millions of people who don't. And nonetheless, I hope you have a wonderful weekend. It's supposed to be gorgeous for parts of the world, and in other parts of the world, it's probably going to be too hot, too cold, too rainy, too windy, too uncomfortable for some. Anyways, this is not what we talk about weather or what's going on around that realm, but we're going to talk about what's going on in the economy and with the money. So we're going to be covering a little bit about what has happened with the stock market, as some people call it, the stonks. And we're going to be looking at what happened with the Tesla stock, because I know there's many people that are very bullish on Tesla. We're going to be talking about why the new narrative has popped out that this tech sell-off is actually a very, very good thing, which, could be potentially very healthy thing, because we've been pumping and you have to kind of come down and close the gap, and we haven't done that. So is this going to be a minor sell-off? Is it going to be major? Nobody really knows. I think everybody's hoping that it's a minor sort of bump in the road as opposed to another nosedive, but we'll see. Only time will tell. We're going to be talking about the layoffs because we're seeing a second round of layoffs, but it's affecting different kinds of jobs. And so now this is creating a very interesting time and place in our economy, and it's important to talk about it. Now, we've been talking a lot about real estate and what's going on, particularly because I think it blew everybody's mind that CDC would be the one to sort of ban on evictions. And there's a lot of this super negative news about how much or how many people are about to face eviction or could potentially face eviction. So we have found an article where they're just sort of comparing the data and have invited landlords to actually chime in. And we're going to go in and take a look at some of their comments so that we can get a little bit better sort of situation of what is actually happening. Because better believe it or not, there's a lot of fake news, and it's very possible that when I stumble on something and don't even know that it's freaking fake, that I might help spreading it. So I want to always look for new information, new data, where is it coming from, who is sharing it, sort of what's happening, so that I can start forming my own opinion of what's happening around the world. We're going to be taking a look at some of the charts for some of the indexes for gold. We're going to take a very brief look over into cryptos and how they have been performing and what's going on in their neck of the woods and charts, because all of them are kind of running together. And that is going to give us a pretty good picture of kind of where the week has gone. And then, of course, we're going to continue doing the shows on Sunday and on Monday, both which are potentially holidays. But we're going to do them nonetheless. And at that point, we're going to focus a lot more on cryptos. So anyways, as you can see, we have a very, very full show to talk about where we are, sort of the state of everything, to kind of summarize what in the world has transpired, because a lot has happened in this last week. And I think as we continue going into November elections, even more is going to be popping up. And we got to prepare how to not just make money, but preserve what we have. Let's do this. All right. Well, here we go. Here we go. Here we go. Hopefully you could hear that, because it went silent on my end. So who the heck knows? Look, I'm still struggling with technology, y'all. I'm still learning this puppy, and I know you're getting sick and tired of me saying that stuff, but it's the truth. It's the truth. I did not grow up with the computers or any of that stuff. My first cell phone was a freaking brick from Nokia. And it was mostly because my dad got one at work. And so, to look cool, I would ask on weekends if I could borrow it. So I would walk around with this giant thing strapped on my jeans. I was like pulling my pants down. Anyways, I'm sure we've all done embarrassing things, but that's one embarrassing thing that I can share with you. Okay, let's take a look at what's going on with the crypto market. So we're going to go and start with the charts, then we're going to go and jump into the stories. And as you can see, when we look at the crypto markets, it is down. It's predominantly red. We do see some green here and there. And again, it's mostly stable coins. Yet one more time. So as you can see, if we take a look at what's going on change-wise, we do have some that have performed pretty okay. BitShares up 20.5%, Cybervein up 14.2, OMG up 9.9, Quant 3.4, Storj 1%, and then everything else is close to zero, basically didn't move, and then we get into the red. So as you can see, not a whole lot of upward momentum. When we go into the downward momentum, you will notice that there's some very big DeFi projects that have kind of rolled out. They're not huge by market cap per se, right? Because they still have a very small market cap, but they're big because people have been using them. So we can see 45.4% for Sushi Swap. Ouch. Then down 26.68% for Flexicoin, down 23.35% for Yearn Finance or Wi-Fi or iFi or YFI or whatever you want to call it. And if you will recall, Yearn Finance only a week ago was at about $38,000 or something like that. They're down to 22,300 something. So that's a very big drop. Kusama down 20.8, Tron down 20.7, Loopring down 20.4, Ren, Serum, DeFi Money, Polkadot. These are big, big, big downward movements. So nothing to be joking about. And as always, we said, kind of, you take a little bit of risk when you do this kind of stuff. And of course, people did take some risk. And now we're actually seeing that stuff. Now we're going to take a look at the Bitcoin chart for a moment, just to kind of see, just because it's the biggest one. And as you can see, it's down in 10,000s. Low 10,000s. BitPay apparently is 11,300, but everywhere else is like 10,200 something, right? And if I want to zoom out, then you can see kind of what has happened. We were sort of sideways-ish, right? Then we had this big old jump, went sideways and back down. And right now, when you zoom out on this, I know the bar charts are typically short-lived, short-term, but it does look like a bar chart to me, right? Went sharply up, kind of side, sharply down. I'm not saying it is. I'm just saying it looks like one. I call them as I see them. This is the March when we went severely down. Then we've been performing, we went up, mostly sideways, went up, kind of sideways. Now we're coming back down. But Bitcoin is not the only thing that is going down. Never mind. We've already looked at that stuff. Here we go. We're going to look at some additional charts. Hold on. Before we go to silver, let's go and take a look at Dow Jones Industrial. As you will see that they are also down for the day. And if we look at the 5-day, you will kind of see what happened. Monday, Tuesday, sort of flattish. Wednesday went up. Thursday kind of hit this, peak in the morning, and then it's kind of gone down since then. Similar story is transpiring with other indexes as well. As you can see, NASDAQ is down. When we take a look at the 5-day, same story, kind of somewhat up, but kind of flat. Then it actually hit Wednesday, and then it's sort of been trading down since then. So we have 2 down days. S&P 500, very much the same thing. Hit on high over here September 2nd, and then it's been trading down. Now, one thing that has been going up is Treasury 10-year yield. So as you can see, it has actually gone up quite a bit, which means that the price of treasuries has gone up, but the yield has price has gone down, but the yield has gone up, and you can see the yield has gone up almost 16%. That's a pretty big move for a bond. Here we're going to take a look at the live gold price, and as you can see, gold is holding predominantly steady in 1930s, not the year, but the price. And right over here, we can take a look at what's been going on with the gold price. So here is the 30-day gold. Kind of looks like historic chart. We hit that high of over 2,000. We have come down since then, and now we're sort of bouncing around sideways. In a 60-day, you can see this much cleaner, right? You see this sort of run up and the sideways sort of movement. That is pretty normal. When something pumps, it's supposed to go sideways. It's supposed to come down a little bit, and maybe that is the story that we're seeing with the stonks as well, as they call them. Here we go, live silver price. It's right now it's flirting with that 26 high 26 low $27 mark, predominantly flattish, right? And you can see again, if we look at the 30 day, it's been kind of bouncing in this channel of like between 25 and 27 dollars. Well, 29 over here, but it's mostly now around that $27 mark that it's been kind of going back and forth with. And you can see again, 60-day, it's done a very nice bump. It's come down a little bit, and now it's going sideways. Now, that could potentially be bullish, and it could be incredibly bullish for gold and silver, especially if the market sell off continues after the Labor Day. Now, of course, they're not going to trade on Monday. It's going to be closed because it is a holiday. But then after that, the markets will reopen, and then who knows what's going to happen? Anything is possible. Speaking of stocks, it's time to discuss what's been going on with Tesla. Now, Tesla has been super popular and kind of built this almost like a Tesla army. I don't know how else to call it. Maybe there is a name for it, but I simply don't know what the name is. And the people were very, very bullish and very protective of Tesla, and they are die-hard fans of Tesla. So congrats to Elon Musk for creating that kind of community, that kind of consumer feeling and passion about what they're doing and what they're creating. That is always quite amazing to see. Now, does it make financial sense to bet on it ad nauseum? I don't know. That's for you to decide. But it is kind of cool to see that sort of momentum for any business where people are diehard fans. We saw it with Apple, we see it with Tesla. So it's kind of cool that we're seeing with some of these companies. So let's take a look at this and what's going on. So Tesla was one of the candidates, I guess, to be added to S&P 500, but it wasn't. And after hours, the shares actually went down. After regular trading hours on Friday, S&P Dow Jones indices announced which companies would join the S&P 500, and Tesla tragically was not on the list. Tesla shares plunged 7% to $387, and shares are now down 25% in 4 days of trading. And you can see that what's been happening. Now, they've been doing a lot of stock splits, so the price would have been even higher, but they've been splitting the stock, and so you can see kind of went on up, came back down, then it did another leg up even higher, came on down, then it did another leg even higher, then came down. My question now is, are we going to repeat the pattern? I don't know. So it's going to be very, very interesting if this pattern is going to repeat. Some people might bet on yes, so we might see that people are going to start buying in and moving on up with the price. But again, it's not a guaranteed. It's very speculative, so to each their own. Play the game if you want. My only advice, not that I give advice, nor anything that I say in this episode should be taken as advice. Just be careful, Do your own research, do your own math. Don't rely on third-party sources. Do a deep dive and listen to many, many people, read many, many documents, and come up with your own thinking and solution and prediction, I guess. The press release announced the 3 companies that will be added to S&P 500 are Etsy, Teradyne, and Catalent. And 3 companies that would be kicked off are H&R Block, Coty, and Kohl's. And the change is going to come in on 21st of September. Now, press release didn't say specifically why Tesla wasn't included, but one of the minimum requirements is that the company make a profit on a GAAP basis for 4 quarters in a row, and GAAP is generally accepted accounting principles. So there are basically rules that companies kind of have to adhere to of how to calculate, you know, loses, losses or winnings, and that became loses. So way to go, Nev. Mm. So they're basically saying in this report, I don't know if this is true or not, but this is what the report is saying. So you let me know what you think. Tesla accomplished that by hook and crook with its Q2 earnings report on stagnating revenues and 428 million in regulatory credit in the quarter and 782 million dollars in regulatory credit in the first half. Without these regulatory credits, Tesla's GAAP earnings would have been deep in red both quarters this year. So I'm not quite sure what has happened, why it has happened. You let me know how you feel about it and what you think about the whole thing. And speaking of letting me know, do so in the chat if you're watching this live on onedealaway.com. And we're going to do Q&A at the end of the session as always. And if you're watching this on YouTube, do comment. I do listen. I do read. I do respond. I do answer. Let me know what you think. Also, do me a favor. Smash that like button. Do subscribe and hit a bell button so you get notified every time a new show shows up, which is basically every single day. So if you're into the money and that kind of stuff, then this could potentially be a show for you. I'm not saying it's the only one, but hey, maybe, just maybe it does do something for you. And if it does, hey, let me know. Anyways, now it's time to kind of look into this whole stocks and what's been going on. As you noticed, we've been pumping since March, and we've been pumping for way longer than I thought we would. But again, the Fed stepped in. They made announcements they're going to buy stuff. Then they started buying stuff. Everybody was feeling safe and secure that the Fed is going to backstop any sort of failure or anything else. People were receiving extra money, right? We had that $1,200 check one time. Then unemployment, folks who are on unemployment were receiving additional $600 above and beyond of unemployment. Many of them making more without working than while working, right? Now, of course, all of that has dried up. So when all of that was happening, of course, everybody was jumping in. Everybody was going and investing. Well, I can't say everybody, but a lot of people. A lot of people have been doing that stuff. Now, since then, Fed started pulling back and is not buying as much stuff. Most people don't know that, but it's the truth. Feel free to fact check me, as I like to say. Do the research. Let me know what you find. So they started pulling back. Now, we also know that $1,200 check, we got only one. Well, for most of us, that's gone, right? A long time ago, it was gone within that 1 month, maybe two. Maybe you stretched it up to 3 or 4, but it's gone now, for sure. And because we've been at it for 6 months. Can you believe it? We've been at it for 6 months, y'all. Half a year we've been at it, and it's not done and over with quite yet. We still have long ways to go. So that has stopped. Then what we also experienced is that the $600 unemployment benefit also stopped and went away. So a lot of these sort of things that were sort of boosted, they all went away. The support is gone, and now we're all dangling in the air, hanging off of a mostly rotten branches, waiting for who's gonna start dropping off when. And now you hear people yelling, "Don't wiggle." Right? Don't move because we don't want this branch to crack. And branches are cracking all over the place. And now it's time to take a look at what's going on with this sell-off stuff. Is it normal? Is it natural? Or is it just a temporary sort of that, as I said, when everything pumps down, it kind of has to come down and go sideways to kind of fill in the gap. Is that what's going on? Or are we in for another crash? I don't think anybody can say for certain, but it definitely makes it for very interesting upcoming trading sessions if you are into that kind of stuff. If you've invested in Apple, Tesla, or many other stocks for which not even the sky was the limit, it has been a little rough over the past few days. But a new meme is circulating on Wall Street, and it basically says that there is a very geeky, super explanatory reason for a sell-up having a lot to do with call options and Robinhood traders needing to get wiped out, and SoftBank buying all these call options, which is what is causing the crack in the system. Is it true? Is it not? I don't know. But this article was very interesting to read, so we're going to take a look at it together. Stocks reacting to and reflecting reality would be the worst case scenario, but that is not what's happening, is what they're saying. It's just a technical issue that will go away because of all these call options. Now, is that true? Is that not? I really don't know, but they're saying this type of sell up could be a very good news for the tech stock. It explains further that unsophisticated investors getting burned with complex instruments are less worrying cause. And I agree, it's much less worrying cause if it's unsophisticated investors and a minor adjustment than the market starting to price in the economy for real. Because if that is the case, then we're going to have a super big sell off. But again, I have no clue. My crystal ball broke years ago. Robinhood option traders are now considered the sacrificial lamb. Now, what has happened is that many people that don't know how to do stuff, because Robinhood made it so easy and super easy, and it would sort of like give you this prediction, like you could make so much money, right? Like it's kind of like the sign driving down the highway. It's like, the mega billions or whatever it's called, the lottery thing, is now at so many millions. Basically to get us enticed and excited to go in and buy the ticket and then scratch it, or whatever you do with the darn things, and then cross your fingers and hope that you make it big and you can go home, dancing, and go sit on the beach or whatever. So the theory is based on the huge jump in options trading, and particularly of call options linked to the biggest names that are on everyone's lips. Buyers of call options gain the right but not the obligation to buy the underlying shares at a predetermined strike price and within the set time limit, right? This is a risk for writers of call options, and these writers are financial institutions. The writers basically the ones that sell them, right? The writing call options provide an income stream for them because you buy it, right? So it gives them that. But to hedge against that risk, writers buy the underlying shares when they write the call option. So they buy the stuff and sell you the option, and they basically make money, or hope to make money on the spread. So far so good. If option volume isn't huge and the volume of call options and put options, which is basically the opposite side of the spectrum, are not too far apart, there's not a huge impact on the overall market. However, that's not the case. Option trading has gone through the roof and super heavily skewed towards the call options. Call options are typically like the bullish side of the things, right? You put a call option when you expect everything to go to the moon, and it sounds like all of the investors, or not all of them, but a large portion of the investors, were definitely very, very bullish, and the call option volume soared 68%. Now, of course, individual investors entered this very complex derivative market, and they were starting to go in, and this market is very, very good for the brokerages because they will make way more money through the complex derivatives than they do just by selling stocks, bonds, ETFs, right? And now you have with the Robinhood being so easy and stuff, people started to jump into it. Very easy entry point for amateurs. It doesn't cost you anything. Boom, you just go in, and people started to go into it, following the whole mantra of stocks never go down, which clearly they started watching news in June, I guess. I don't know. And so now they're applying in. Now, financial institutions which were selling the large volume of call options were buying large volumes of underlying shares to hedge against the risk. Well, when people are buying the call options, and the sellers of call options, the writers of call options, have to go in and buy the underlying assets, it means that it boosts the price on up. And of course, it kind of keeps on going on up, 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 until the rally can unravel very quickly at the first sign of trouble, and unravel has happened. Now what? Well, blowing out those Robinhood call option traders and wiping them out of their accounts will reset the rally of sorts, so the theme goes. The rally in tech stocks can then continue. We'll wipe out all of these small folks, and then it will continue. And any theory, even based on wiping out the sacrificial lambs, aka the Robinhood traders, trading is better than seeing the absurdity of having the biggest stock market rally leading to record stock prices during the worst economic crisis in a lifetime or two. So there we go. That's kind of what's been going on, and they're sort of explaining it with us. This is one option, of course. The other option, no pun intended whatsoever, is that maybe the markets are finally starting to price in actual earnings, actual what's going on with companies, the acquisitions, the mergers, the die-offs, the sell-offs, the bankruptcies, right? The collapse of what we're seeing left, right, and sideways, as I like to say. And I truly know that left and right is sideways. Okay, I get it. I know, but I think it's funny to say it. So, play along with me. Play along with me. So, we'll see which way it goes. My heart does truly go out to the Robinhood traders. As I've been saying over and over and over again, you want to definitely be careful. Spend some time and money learning as opposed to just throwing money towards these things, because when you just throw money towards these things, people are very, very sophisticated in what they do. They have algorithms, they have computers, they have robots, and you can't compete with them. They have a ginormous team that has, hundreds of years of experience combined, and you will get slaughtered inside this stuff. But most people, well, they think of like, well, look at this, like I did so well, let me go into it. And so they start going in. So I don't know how many people have lost money or how much money was lost, but it is a lot, right? And my sincere hope is that at least the watchers of Money Matters were smart enough to protect themselves and not do silly things by gambling against all of this stuff and gambling with the money. Come on, y'all. If you're going to invest intelligently. Don't gamble with your money. That's just silly. My humble opinion, according to me. Okay? All right. So what's going on with the layoffs now? Now, this is another layer of sort of where we are and what's going on, that potentially, are we entering sort of like a, phase three, as I like to say. First phase was the deep dive, right? Second phase was the rally on up, also known as the suckers rally. And many suckers have made a lot of money if they actually have properly, entered and exited. Many swing traders and day traders I know have made substantial amount of money. So congrats if you did that. I always get excited when people make money. And now, question is, are we entering the third phase, which is sort of the second leg down, as they say? We'll see. Only time will tell. First, the job cuts were hit the lower level employees, right? The retail service worker and that kind of stuff. Then retailers started trimming the corporate jobs. Then airlines started trimming the stuff. And innumerable companies have quietly been laying off workers one by one, or in dozens, I guess. Many companies have shut down. Many companies are never coming back. And many jobs are never coming back. And the problem started to hit the supply chains. And of course, then it sort of kept going on up because we had both demand and supply problems. Now, while millions of these lower level paid employees are now being brought back, and what we're seeing happening everywhere, a whole new wave of layoffs has been building a momentum, but now it's hitting a well-paid jobs with decent benefits in big companies, including tech, and financials, and all kinds of stuff. So we're going to go through some of the companies that are going in, but this is one of those things that we already talked about a few months back, that typically when we see this stuff, the lower level jobs get hit first, then we start hitting the higher level jobs. And at first, right, when there's a panic, you just sort of eliminate, like maybe the extra, maybe the ones that you don't really need, that you don't really want, that you don't really like, whatever, right? Whatever the case is, you eliminate that stuff, and then you kind of hold still. Well, things are not getting better, so now we're actually getting into going with a very, very detailed and strategic ways to sort of lay people off, and not just furlough them for a few months. I mean, these are complete layoffs. Salesforce confirmed rumors it was laying off 1,000 employees even after it posted the really good sort of the expectations, and the stocks rocketed and all of that stuff. Coca-Cola announced that it would offer voluntary buyouts to about 4,000 employees, and then it would lay off other employees. C.H. Robinson in April furloughed 7% of its workforce, or about 1,000 people. Now it turns out it won't bring back hundreds of them because their jobs have been automated during their absence. We've been talking about that stuff, that automation is going to replace many of the jobs out there. Wells Fargo, which has slashed its dividends by 80%, is now trying to cut costs, and the bank resumed regular job displacement activity. They didn't say exactly how many, but some sources here mentioned in the article saying could potentially lead to tens of thousands of jobs getting cut over the next few months. MGM Resorts said it would lay off 18,000 workers. NBC Universal Studio, a unit of Comcast, started cutting up to 10% of its workforce. AT&T, which owns the Warner Brothers Studios and cable channels HBO, CNN, and TBS, has also started slashing its workforce. Black & Decker announced at the end of July it would lay off 1,000 people. LinkedIn, owned by Microsoft, announced it would lay off about 1,000 employees. The airlines are now announcing more staff shedding between American Airlines, United Airlines, and Delta. The additional counts announced so far could amount to more than 55,000 employees. And in one place, I actually heard or saw, whatever, I can't remember, 70,000. That's a lot. Boeing said that at the end of July, it is preparing a second round of buyouts in this year. The 10% cut of its workforce unveiled in April wasn't enough. They need to cut more. Raytheon said at the end of July that it cut 8,000 employees. General Electric had already announced in May that its aviation unit would cut 13,000 jobs. Schlumberg, the giant U.S. oil field service, provided through another 21,000 jobs that are being cut. Goldman Sachs estimates that nearly a quarter of U.S. workers that were temporarily furloughed probably won't be called back either. That's millions of people that are being added. Now, this is a very interesting piece that I think it's worthwhile reading and understanding. Outplacement giant Randstad RiseSmart released a survey a few days ago of human resource executives in 20 industries that found that nearly half of U.S. employers who have already furloughed or laid off staff as a result of the pandemic are considering making additional cuts over the upcoming 12 months. So the layoffs are nowhere near over. Now it's a methodical, systematic, carefully planned, and calculated. Now companies are looking at data and projections, and they're going through their workforce with a fine-tooth comb to trim jobs and costs. Over the past 4 weeks, nearly 7 million people filed initial unemployment claim. However, well-paid jobs in big companies in carefully orchestrated and calculated moves based on projections where their business is heading over the next few years. So as you can see, it's not going to be pretty anytime soon. Now, over the same 4 week period, the total number of people on unemployment insurance dropped by 4 million from 31 to 27 million. What this means is that 4 million more people got their jobs back and they were newly laid off. So 7 laid off, right? 4 had to go back because, right, because we actually dropped. So it didn't go up, it actually went down, which means that 4 more million people than just 7 that got laid off got their jobs back. However, what the article is saying is that many of those people who got their jobs back are working in retail and restaurants and in the lower paid end of the services sector. It's sort of a sector rotation of layoffs, with layoffs rotating into industries with higher pay and decent benefits, hitting many of the people that had been spared in early months of the pandemic. Now, this creates another sort of conundrum. They don't talk about it here in the article, but it's just my way of thinking right now, right? So, my Nev's commentary, I guess. And so, if we think about what is going on, right, that when you look at just the numbers, you're seeing that some, based off of the article, based off of the report, right, that the jobs that are being sort of brought back slash created are the ones with the lower income, less money being paid out, and the ones that are being cut are the ones that are typically higher paid, more benefits. What this basically means is the same thing that we talked about, I want to say about a month ago or so, where I said that this is going to be starting to happen when we're going to start seeing deflation when it comes to our income, but it's going to be inflation when it comes to the costs of living. I will explain in just a moment what I'm talking about, the cost of living. Trust me, you will want to know this stuff. But, anyways, so we're getting less money, right? But we're paying more, which means that we're getting squeezed now even harder, even further, even stronger, and even longer. All right? The other piece that also worries me is that if we are bringing folks back to jobs into restaurants and hotels and resorts and entertainment and that kind of stuff, but we're cutting the jobs of people that are, in well-employed sector that can afford to go to restaurants and pay the bills and sort of support these jobs. If this goes away, these will go away as well. So it's a double conundrum, which could be yet another drop. So my personal thinking is that, now, is it going to hit the stock market? I got nothing, man. That thing is so manipulated that nobody can tell you where it's going to go. Okay, not even Nostradamus would know where the heck that thing is going to go. But I think when it comes to economy, is that we're going to basically, just one of those, like, it's kind of like a roller coaster when you go down, right, and kind of right up and down and kind of right up and down. And so that's what I expect it's going to be. It's going to be yet another sharp decline down over the upcoming months, and it's going to be pretty darn ugly. Now, I talked about the prices going up. And of course, if you've gone to the grocery stores and that kind of stuff, you likely have noticed that some of the things have gone up. You likely have noticed that prices of certain things have gone up. And not only that, but it looks like housing prices will go up. And I'm not just talking about the houses you buy, because we've been talking about that stuff, and the prices, right? The purchasing of the homes has continued, and it has been driving the prices up. I'm saying rental prices are going to go up. Let's take a look. All right. So here we go. We get another report of someone saying, like, hey, landlords, please let us know what's going on, because we're getting this very, very weird data. Let's read, let's learn, let's discover where we are. There's a nationwide eviction moratorium through December 31st by the U.S. Centers for Disease Control and Prevention, CDC. We already know that. We've discussed it. Order covers all renters in the U.S. below a certain income level, individuals who expect to earn less than $99,000 this year, and joint filers expecting to earn less than $198,000 combined. Under these eviction bans, renters still owe the rent, but they cannot be evicted for non-payment of rent. The landlord can pursue legal action in courts to obtain judgment. They collect on the judgment, but cannot evict the tenant for non-payment, right? Properties are usually leveraged. Landlords carry mortgages on those properties and have to make mortgage payments. Many of those mortgages have been bundled into mortgage-backed securities. We've been talking about this stuff, right? Tenant doesn't pay, landlord can't pay. If landlord doesn't pay, the bank can't pay the investors. If investors cannot pay, right? Like, it's a trickle on up problem that has poised to really explode and take down the entire financial system. Very, very high risk thing of what's going on right now. There's a risk that these cash flows up the pipeline from renter to landlord to creditor and investor are halted, triggering a rolling tsunami of defaults and foreclosures amid landlords. But not just that, I'm saying it's going to hit potentially banks and entire financial sector, right? So, something for us to watch for. Or so it would seem. But really, what's going on? Now, surveys by Apartment List of about 4,000 households have indicated that about one-third of households did not make their full housing payments in July and August. One third out of 4,000. These housing payments includes rent and mortgage payments. That is huge. But this dismal data on non-payment based on household surveys does not parallel the data supplied by large landlords. National Multifamily Housing Council, NMHC, which represents landlords of multifamily apartment buildings, has started to track rent payments. And they actually went out and surveyed 11.4 million professionally managed market rate rental properties. As of August 27, so only a few days ago, 92.1% of apartment households made a full or partial payment. And here's kind of how they broke it down. By August 6th, 79.3 made some sort of payment, right? 86.9% by the 13th, 90% by the 20th, and by the 27th, 92.1% made a rent payment, down only 1.9 percentage points from August 27th, 2019, right, which was 94%. The chart shows rent collection by week compared to the same week in the same month last year. And you can see right here, here is 2019, what's going on? Here is 2020. And as you can see, April was definitely on the low end. We kind of went, sort of caught up in May. In June, we were pretty darn close. I mean, 94.7 to 94.2, slightly down, but not by that much. July, 93.3 to 95.3, 92.1 to 94. So it's not as large of a discrepancy. It's a discrepancy for sure, but not as huge, right? Not as huge. If this deterioration of non-payment of 1.9% points as experienced by landlords of 11.4 million apartments is applied to 43 million renters in the United States, that would mean that roughly 817,000 households in the US have fallen behind on rent. This is not anywhere near the huge numbers being thrown around in the media. For example, the Aspen Institute proclaimed, quote, 20 million renters are at risk of eviction. So what is it? 817,000 or 20 million? Because that's a very large gap. Very, very large gap. So they're saying, hey, landlords, let us know. Put stuff in the comments of what's going on and what are you seeing. And of course, then I started to scroll down. I'm like, well, I'm curious. I want to know what's going on. So here we go. We're going to take a look at some of the stuff of what the landlords are reporting. One of them says, Washington near Seattle, 3 small cottages, none are vacant, all are current on rent. 3 units, 2 renters have stopped paying, and I have 2 units that I will default on my mortgage. So this one says 39 units, 100% at occupancy, all in Rhode Island. The rents have never in 10 years come in so early and consistently. A friend with over 2,000 units in Rhode Island, and his experience is the same as mine. He has never in 50 years seen the rents come in like this. In Arizona, now that UI isn't paying extra, I'm starting to see some cracks. 95% occupancy. I'm raising rents and looking for more units. I don't have mortgage anymore. Very interesting. So we're going to pause over here. So far, we've heard from 4 different individuals. One is basically saying that is struggling. One is saying that seeing some cracks, 95% occupancy, but I'm shopping for more. I'm very bullish. I'm excited, right? I'm looking for more units, and I'm raising rents. You're going to see this as a theme coming on up. Just wait until we continue scrolling. And then, of course, the rest of them are saying 100% occupied. People are paying on time. They're paying early, actually. They are like super, super responsible about the whole thing. Let's continue. Maryland, tenants owe 6,000 plus in rent, and it's sort of struggling and stuff. So there you go. You have another one that is sort of on the down. I don't know if you're keeping the track, but let's go through it. So they're talking about maybe you should think about forbearance and blah blah. So this one said over here, my tenant immediately stopped all rent payments when my state banned evictions. When the state lifted the eviction ban in July, he started paying rent again. Now, I'm certain that he's going to stop the moment this is rolling out. So there you go. You do get some of that stuff as well. This one says, one rental in Portland, 2 houses 90 miles away in Astoria, 100% occupancy and always paid on time. Seattle, both are current, both 100% current. 120 units in San Diego. Some people gave notice to leave. We're asking double security deposit for new applicants and have almost no vacancy. All tenants are current. So you will see this rising as a theme. Couple of themes that we can derive from this stuff, and you will see it come a few more times. But I will share in the chat of where you can read this if you want to for yourself. But what we're seeing is people are raising rents. People are asking for more security deposit. People are triple checking all of their stuff, right? When they're going through it, right? So that's kind of where the theme is happening here, and it's going to get worse. Just wait and see what other people are saying. This was saying, let me see over here. So this one is saying that, you know, conversation that this particular reader had with the son, and said, I believe that you could see the landlords requesting 2 to 4 months rent as a security deposit in 21-22. Affordable apartments will no longer have any appeal to builders. Instead, builders will only focus on the high income apartments. And this is what we have been seeing over and over and over again. So, one of the themes that is emerging out of this whole stuff, out of this whole conundrum, I guess, that's the best way that I can call it, is the fact that what is going on is that the rental prices are going up. People are double checking on the employment. They're asking for extra securities they haven't asked for before, anywhere from double the security, extra months, all kinds of other things that they haven't asked in the past. Now, of course, if you are a landlord, you want to make sure you check your laws. And the Kitticus is right over here. He wanted to say hello. Want to say hello? Yeah, I know. Yeah. So the mascot has decided to say hello for a brief moment. Anyways, um, if you are a landlord, you definitely want to understand your laws. You cannot illegally collect stuff. You don't want to get yourself in trouble and in hot waters, as I like to say. So do check your laws in your particular state of what you can and cannot do. But you definitely want to be super, super, super careful about whom you're letting in and how you're conducting stuff. So there you go. That is what we have right now. We're going to jump into the Q&A on the live site. For everybody watching on YouTube, thank you so much. Smash that like button, hit the subscribe and a bell, and I will see you tomorrow. Until then, stay forever money blessed, and do remember, you are only one deal away.